Hi traders, I'm Lance Beggs. Welcome to part 3 of our series on exits. Based on the information we discussed in parts 1 and 2, let's now review my personal approach to exit management for short-term intraday trades. As always, if you prefer to read this topic in article format, you'll find it at my website, www.yourtradingcoach.com. So my approach to exits. The best way to do this is to first consider what is my goal from trading, how do my chosen markets move, and what psychological needs do I have to satisfy with regards to my trade management and exits. Firstly, what am I trying to achieve with my day trading? My ultimate goal is consistent income. I'm not swinging for the big home run trades. If I get one, that's great, but it's not the goal. I trade for income. I accept that not every day will end in profit, but I do aim for each week to end profitably and certainly every month. So I can't wait around for the big moves. I trade the small swings and I look for consistent income. So in developing my exit strategy, we need to consider a requirement for consistent income. This means that both a high percentage of winning trades and tight risk control are important factors in the design of my exit strategy. To some degree, traders often see these requirements as mutually exclusive. While a higher percentage of winning trades is often achieved by widening stops, this is not possible in my circumstances where I need to also keep risk as low as possible. I am satisfied though that the nature of my preferred setups being at areas of support and resistance generally ensure a high probability entry. As such, my stops can be placed as tight as market action allows. I have a couple of other requirements as well. In order to minimise risk, no trade can ever be allowed to place my trading career at risk. The average win-loss ratio must be kept under control such that the average loss is easily overcome by one average win, and any individual loss should never be such that it cannot be overcome by one profitable day's trading. How do my markets move? I had a reader ask recently whether I believe the saying, "the trend is your friend." Well, if that saying is true, then I believe it's a very fickle friend indeed. I find trend trading very difficult psychologically due to the lower winning percentage that trend traders typically have to endure as they get chopped up again and again waiting for the big move. There's a commonly stated belief that Forex markets trend really well. That may be true in longer time frames, but my experience doesn't agree with that for the short time frames that I trade. These markets spend a lot more time in sideways or choppy market action, rather than nicely trending. Of course, when they do trend, it can be a great move. So given that is my view of the markets and the timeframes I trade, I need an exit strategy that does not rely on trends developing. Perhaps then, for me, predetermined price targets will be the better strategy. But what about my psychology? What needs do I have to satisfy, and are they compatible with my goals and my view of the markets? Firstly, I hate losses, but even more, I hate unnecessary losses. So I will immediately take any loss when the system says to exit, in order to ensure the loss is no greater than necessary. Under no circumstances will I accept a lack of discipline on my part leading to a loss greater than the predefined stop loss. So I need a clearly defined exit strategy and full focus while in a trade to ensure I manage my risk as per my trading plan. Secondly, there is nothing worse for me than seeing a profitable trade turn into a loss. I'm happy if it retraces and I get out at a small profit. I'm happy if it retraces and I get out at break even. But if it's in profit and retraces and I let it go to a loss, I've failed in my job of managing this trade. So I need to perhaps consider an aggressive movement of the stop to break even. And thirdly, although I would love to catch all large market moves, I'm not too concerned if I don't trade the whole move. I am happy if I've taken consistent small profits out of the trend at each of the high probability entry points. All three of these psychological requirements are compatible with my goals and view of market direction as described earlier, pointing to a strategy involving tight risk control, aggressive movement of the stop to break even, and taking profits at predetermined price targets. So having established the general requirements for an exit strategy that meets my goals, my view of the market movement, and my psychological needs, let's look at it in a little more detail. Initial stop loss management. The initial stops must be tight but beyond any noise, ideally positioned beyond either the swing highs or lows or the entry candle highs or lows depending on market action. The stop position must be such that if the price gets to that position, then the trade setup and or timing were incorrect and I really want to be out of the markets. If the market is not flowing well and there is considerable candle overlap, then I'll consider placing the stop a few pips further to allow for a minor test and breach of the stop area by a pip or two. The nature of my entries is such that, if they're valid, they should move very quickly into a profitable direction. Therefore, in order to minimise the size of my average loss, I can consider an exit of my position before the fixed stop loss, as per the following rules. Firstly, I will exit the trade before the stop loss if price action indicates that my setup may no longer be valid. This includes any significant stalling of price or loss of momentum, or indications of a possible reversal. If price should set up an entry again, I can always re-enter, but it's better to be out of the market waiting for a valid re-entry than just hoping the current one works. Secondly, if in doubt at any stage about the validity of my entry signal, I will exit and reassess rather than wait for price to hit either the stop or the target. And third, after any reasonable period of time without price achieving a profitable position, usually 3 candles, but that's flexible depending on price action, I will consider exiting or tightening the stop if price action allows. And finally, trades against the direction of the trend are treated more aggressively with respect to early exit. Ongoing exit management. Firstly, aggressive management of the stop to break even as soon as price shows a loss of momentum. If price was only slightly into profitability, then I'll consider tightening the stop loss towards break even if price action allows. Both these actions may result in getting stopped out on a retracement before price moves in the expected direction. That's fine, I accept that. Having exited, I can objectively reassess the entry setup and, if applicable, re-enter the market. And if I don't get a re-entry and the price moves on without me, I don't mind. I missed this one, but getting out was the right thing to do. The retracement could easily have continued in the opposite direction, stopping me out for a greater loss. I have minimised my risk, I have traded well. Secondly, trades against the direction of the trend are once again treated more aggressively with respect to early movement of the stop to break even. Multiple parts. Having established the requirement for consistent income, my primary exit strategy, as mentioned already, will be through a predetermined price target. However, by trading multiple parts to each trade, I will provide myself with greater flexibility. Part 1 will always operate with a take profit level. The location of the target is flexible, depending on my assessment of price action, but will typically be the next area of minor or major support or resistance. Part 2 will involve either of the following. In a smoothly trending market, this part will be managed via a trailing stop, positioned beyond the swing highs or lows. It may be moved tighter for any parabolic or impulse move to lock in a portion of those extra profits, and in this case I'll consider positioning the stop based on a smaller time frame price action if possible. Or secondly, in a sideways market, or a choppy market, whether trending or not, Part 2 will be exited via a target level, typically the next major support or resistance level beyond the one used for Part 1. Supposedly anyway, the market is not trending around 70% of the time, therefore this is the default exit method, being a predetermined price target. Trailing stops should only be used when the market is visibly trending in a very smooth fashion. If price stalls prior to achieving either target, Part 1 may be exited any time. Part 2 should be given more opportunity to reach its target, or a break-even exit, however may also be exited if the trade has lost its edge. News or economic releases. Prior to any news or economic release in which it's reasonable to expect volatility, I'll consider either closing out trades, or if they're well in profit, then just tightening the stops right up. If extreme volatility is possible, for example during the monthly non-farm payroll release or any interest rate decision, and I haven't closed the trade, then Part 2 profit targets may be removed from the market to allow that trade room to move and run. That's essentially it. It's really quite simple, but it has considerable flexibility to allow for discretionary changes based on my feel of the market flow. I'll repeat a few of the disclaimers already mentioned in other articles and videos. This exit strategy is simply the one I have found most effective for me. It is not necessarily the most profitable. In fact, my testing shows slightly better results by just trading Part 2 positions. However, it's optimized to suit my psychology, which needs these regular profits no matter how small. I like it, it works for me. There's no guarantee it will suit your style of trading, or in fact will even be profitable for you at all. By all means, consider it education and take the parts you like to see if they can be fit within your strategy. The key word though is test. Test everything before taking it live. There are numerous variations on this multiple part approach as well, so adapt that approach as you see fit and don't just limit your testing to the multiple part exit. Why not try also scaling in with each part at a different price? I hope you got great value out of that. I'd like to finish up with acknowledging 4 great traders who have been influential in helping shape my beliefs about trade management and exits through sharing a couple of exit-based quotes from their books or websites. But we're out of time, so I'll have to pause here and continue that in Part 4. I'm Lance Beggs from YourTradingCoach.com. Happy trading.